stock market can be a pretty scary place. When things go badly, people can lose their jobs and see the value of their savings fall dramatically. You'll remember we had one of the worst stock market crashes ever in 2008. In just 1 week, London's flagship FTSE 100 index fell by 20%. So if you had had £10,000 in a stocks and shares ISA at the beginning of the week, that would have fallen to £8,000 7 days later. On the other hand, the stock market can be a great way to make money. Warren Buffett, the famous US investor, started out with $150,000 in 1956, and he's now worth $47 billion. And on top of that, he's given away billions more to charity. So just how risky is investing in the stock market? How likely is it that you'll permanently lose money? And what can you do to reduce the risk?
The stock market isn't as risky as people think, provided they build an effective investment strategy. If they diversify their investments, don't just pick one stock or one fund, and maybe mix in with other asset classes as well, they can have a very sensible long-term return. What happened in 2008 was obviously very painful and very tough, and markets fell very strongly. However, I'd say a couple of points. One is markets have recovered very strongly since then. So actually, if you'd taken a 20-year time horizon, you hadn't lost money. If you'd taken a 10-year time horizon, you hadn't lost money. And secondly, if you'd been investing in good, active managers, you'd participated only part of that fall. Obviously, if you'd done as I mentioned, and you'd also had some bonds in your portfolio would have been far better overall than if you'd been purely in the stock market.
So it's pretty clear diversification is one way to reduce the risk, and investing for the long term is another.
History shows that if you invest in the stock market for at least 10 years, you'll normally do at least okay, and you'll often do a lot better. So if you invested £1,000 in the London stock market at the beginning of the 80s, you'd have had £3,015 by the end of the decade, and that's before you add in inflation. And if you had invested £1,000 at the beginning of the 90s, you'd have ended up with £3,058. And even during the noughties, not a good time for the stock market, you'd have still grown your money to £1,057. And remember, that's before you add in inflation. You could do even better with individual companies. If you had bought shares in Next 5 years ago, your investment would have grown by more than 5 times.
So what's the simplest way to invest in the stock market?
I'd say in a fund. You could either go for an index tracker fund, which just buys all the companies in an index, such as the FTSE 100 index. Or you could go for a fund where a manager selects investments for you. James Bateman co-manages 5 actively managed funds for Fidelity. You'll be able to find some investment funds in the ISA Centre on the Love Money site. Or you could invest via a funds supermarket. These sites offer you a wide range of funds at the lowest prices. 2 of the best-known supermarkets come from Fidelity and Hargreaves Lansdown. You'll find loads more information on both sites.
If you decide to invest in the stock market, good luck. It's a great way to build long-term wealth.